Hey everyone, welcome back to Investment Research. I'm Simo, your independent equity research analyst, and today we're going to dig into Goldman Sachs's top dividend picks for 2026 and why these stocks could be key to building long-term wealth. If you're seeing me for the first time, make sure to subscribe because I break down the market in a way that helps you understand opportunities rather than just follow the headlines. In my view, dividends are one of the most powerful tools for investors. They provide steady cash flow, allow for compounding over time, and give you a sense of security even when the market is volatile. Goldman Sachs just released their forecast for 2026 and they are putting a spotlight on dividends. They see strong growth potential in certain sectors and have identified 5 stocks they believe are strong buy opportunities for income-focused investors. Today, I'll take you through their reasoning, highlight the sectors to watch, and give you my perspective on why these picks matter for anyone building a dividend-focused portfolio. The S&P 500 has been hitting record highs almost every week, which is exciting, but it also raises an important question. Where do you find value and safety when everything feels expensive? In my view, this is the perfect time to consider dividend-paying companies. After a strong bull market run, analysts are anticipating a potential correction of 10 to 15%. This isn't a reason to panic, but it is a reason to be strategic. It might be the right moment to think about rotating some profits from high-growth tech stocks into stable dividend-paying giants that can provide both income and resilience in your portfolio. Goldman Sachs believes that S&P 500 dividends will grow 6% in 2026, slightly higher than the Wall Street consensus. That's a strong signal that they see value in sectors with consistent cash flow and shareholder-friendly management. This confidence comes on the back of already impressive dividend growth, with the S&P 500 seeing a 7% increase year over year so far. For me, that's a clear indication that dividends are not just an afterthought. They are a core part of wealth building in the current market environment. Goldman identifies 3 key sectors that are poised to lead dividend growth in 2026. These are healthcare, utilities, and industrials. Each of these sectors has its own strengths. Healthcare is traditionally resilient because people will always need medical products and services. Utilities are stable and cash-rich, providing essential services that generate consistent revenue regardless of the economic cycle. Industrials offer exposure to companies with strong operational efficiency and growth potential, often tied to infrastructure and essential services. In my view, understanding these sectors is just as important as looking at individual stocks, because it helps you see the broader trends that drive dividend sustainability. Companies in these sectors tend to have strong balance sheets, reliable cash flow, and a history of returning value to shareholders, all of which are critical for long-term investors. Let's start with the utilities sector. The first pick from Goldman Sachs is American Electric Power, or AEP. This company operates at an incredible scale, serving more than 5 million customers across 11 states. What I like about AEP is its diverse energy portfolio. They generate electricity from coal, natural gas, nuclear, hydro, and a growing mix of renewables like solar and wind. The dividend yield is 3.12%. Which is solid, and Goldman's price target is $128. In my view, AEP is a classic utility play that offers stability, reliable income, and exposure to an evolving energy landscape. It's the kind of company that anchors a dividend portfolio because you can count on consistent payouts even during periods of market uncertainty. The second utility pick is Eversource Energy, ticker ES. Eversource is about reliability and a proven track record. The company has increased dividends for 23 consecutive years, which is impressive. Their dividend yield is 4.11%, and Goldman targets the stock at $79. Eversource serves residential, commercial, and industrial customers across Connecticut, Massachusetts, and New Hampshire. They are diversified across electric distribution, electric transmission, natural gas distribution, and water distribution. In my view, this makes them a very defensive play. If you are someone who prioritizes stability and income, Eversource is a compelling option. It's the kind of company that delivers peace of mind while providing steady cash flow to your portfolio. Moving to healthcare, the first pick is Johnson & Johnson, or J&J. This is a global, diversified healthcare giant that many investors know well. J&J offers a dividend yield of 2.81%, trades at 14.5 times forward earnings, and has a Goldman Sachs price objective of $213. The company operates through two main segments: innovative medicine, which focuses on therapies in areas like oncology, immunology, neuroscience, and cardiovascular disease, and medtech, which covers orthopedics, surgery, interventional solutions, and vision care. In my view, J&J is a conservative blue-chip pick that combines stability, brand strength, and dividend growth. It's the type of stock that can form the core of a dividend portfolio, providing both income and exposure to a sector that is less sensitive to economic cycles. The second healthcare pick is Merck, ticker MRK. Merck is trading down over 30% in the last year, which creates what I see as a potential entry point for a world-class company. The dividend yield is 3.61%, and Goldman targets it at $93. Merck operates through two segments: pharmaceuticals, which includes oncology, vaccines, immunology, cardiovascular, and other therapies, and animal health, which covers veterinary pharmaceuticals and health management solutions. In my view, Merck is a perfect example of a company where valuation and dividend strategy intersect. The firm is also involved in strategic collaborations with other industry leaders like AstraZeneca and Bayer, which demonstrates a clear commitment to innovation. This is the kind of healthcare company that can provide both growth and reliable dividends over time. Finally, in the industrial sector, Goldman's pick is L3Harris Technologies, ticker LHX. This company operates in defense technology, providing critical solutions for national security. The dividend yield is 1.66% and the target price is $327. L3Harris provides technology solutions across air, land, sea, space, and cyber domains, with segments including space and airborne systems, integrated mission systems, communication systems, and Aerojet Rocketdyne for propulsion and armament systems. In my view, LHX isn't a traditional income play, but it is a technology powerhouse tied to essential defense spending. Its growth profile is unique because it benefits from non-cyclical, critical government contracts while still providing a dividend. Including a company like this in a dividend-focused portfolio adds exposure to high-quality, mission-critical technology with long-term stability. So, to summarize, the investment thesis from Goldman Sachs is clear. They see continued dividend growth in 2026, and they believe a strategic rotation into high-quality dividend stocks within healthcare, utilities, and industrials can be a smart move. The 5 strong buy picks are American Electric Power, Eversource Energy, Johnson & Johnson, Merck, and L3Harris Technologies. Each offers a different mix of yield, growth, and stability, giving investors options depending on their priorities and risk tolerance. In my view, combining these picks thoughtfully can build a portfolio that generates reliable income while capturing growth potential. If you found this analysis helpful, hit the like button, share this video with anyone interested in building smarter portfolios, and subscribe for more independent equity research and market insights. I'm Simo, your independent equity research analyst, and I'll see you in the next video with more actionable investment research ideas. Good luck to all of you.